Since you mentioned about the currency depreciation, we all know the currency is been falling consistently. So for a common investor, should we see or should they see this as a crisis, or is it a genuine market adjustment for the price?
Let's say, for instance, let's start from the 90s. We had the Asian financial crisis. We had the global financial crisis in 2008. Therefore, I think as investors, as market participants, AI-related, driver for growth. AI has been a big driver for growth. So growth has consistently sort of been above trend in the US. One thing is the acknowledgement of the problem which is there. So like I said, even before the war started in the end of Feb, you had external account issues.
We are hearing that FIs are selling Indian market pretty aggressively.
Yeah.
So how do you feel that effect is impacting Indian economy? Welcome to Wealth Metrics Podcast. Today, if you look at the world, then there is uncertainty everywhere because of the war, recessionary fears, inflation, and also rupee depreciation. And because of this, there is a lot of uncertainty among the minds of investors. To discuss about all these things, today we have a senior economist from Bandhan AMC, Mr. Sreejith Balasubramanian. Welcome, sir, to the podcast.
Hi, Sibin. Thank you. Thank you for having me.
Thank you. Just like we discussed, there is a lot of uncertainty in the mind of each and every investor.
Yeah.
So what do you think about the present situation? Is it a dangerous situation like never before, or this is just another market economic cycle?
That's a good question to start. Actually, I think I would look at it as an economic cycle, not exactly a dangerous situation as I would put it. The only thing is the nature of these cycles have been changing. So I think if you look at in the last 2 to 3 decades, for instance, let's start from the 90s. We had the Asian financial crisis. We had the global financial crisis in 2008. We had the Euro crisis, the issues with countries like Greece with high debt. We had Chinese yuan devaluation instance in 2016-17. So those episodes were more pure economics related, right? Either stemming from economic cycles playing out or from, let's say, financial markets per se. But the kind of events that we've had in the last few years, for instance, more of geopolitics, or for instance, the COVID pandemic, right? So we've had the COVID pandemic in 2020. We had the Russia-Ukraine war, and now the West Asia conflict involving Iran. So I think the nature of crisis has changed. Or rather what we've witnessed has been different. And therefore, I think as investors, as market participants, how we perceive it and how we try to estimate growth, inflation outcomes have been, that has had a more learning cycle there, right? So in a traditional sense, it's very probably easier for us to understand, how the growth impact is going to be, inflation impact, capital flows, trade, and so on. But right since the pandemic, there's been a lot of learning, right? We're all sort of become humble because our forecast going wrong, and then we've corrected ourselves. So there's a lot of learning there. I think it's just the nature of crisis that it really changed, and even that matters not just for market participants, even from a policy perspective. So if you look at the kind of policies that we had since the pandemic, right? So we saw US government policy. So for instance, US government spending pick up very sharply during the pandemic, and the trajectory has changed thereafter. So what kind of responses? For example, we had lockdowns, we had supply issues. So some central banks tried to bolster demand during that. But India didn't do that, for instance, to a great extent, because we sort of probably at some point realized that, when supply is sort of curtailed, there's no real point in increasing demand because that will create a lot of inflationary pressure. So we were, different from, for instance, what the US did and so on. So I think the whole experience is that the last 3 years, I think geopolitics, etc., which we are understanding as we go, has increased. And the nature of the crisis, the nature of the learning is therefore different. So, but it's still a cycle, I would put it that way.
Okay. So eat the difficult frog first, because the social media, everybody is around. There are a lot of talking about the world is heading to recession.
Okay.
Right. So if you look at all the influencers are also talking mostly about it.
Yeah.
So what do you think about, especially about India? So do you feel that India is genuinely heading towards a recession, or is it just a slowdown? So what's your view on that?
Again, I would go for the latter. I would say it's a slowdown. Simply one based on data. Because if you look at recession, for instance, the technical definition of recession is, it's either called 2 quarters of GDP decline, right? So GDP falling, which is not what we are looking at. Or, for instance, if you look at what the US National Bureau of Economic Research, NBER, how they define recession, it's not just based on GDP. they also look at metrics like industrial production, retail sales, non-farm payrolls, real income growth, whether that is declining and to what extent, over what period, etc. Those are the standard definitions of recession, and we don't sort of fit into that anyways. I think the current situation is more like a slowdown where, let's not realize that we were at least slowing down in a nominal sense even before the West Asia conflict started, right? And maybe slightly even before the pandemic to that extent. So, like we discussed earlier before the podcast, the comparison with 2013, for instance, sort of comes up now, right? Quite a bit. Are we in the same situation? I think what sort of is different right now is that our macro situation internally is probably different. It's better. So inflation, fiscal deficit, current account deficit are all better. And therefore our internals are looking better. But what we have today is more of an external account problem, right? So there have been a lot of capital outflows in the last couple of years. That's creating a lot of pressure and that's creating a lot of challenges. Obviously, there will be some positive news on the war, on commodities, oil, etc. But I think more in the next few months ahead, or maybe in the next 1 year, we're sort of still looking at some form of capital account pressures. I think that will be the challenge. But everything put together, I think as an emerging market, as where we stand today in terms of macro, etc., it's more of a slowdown. A recession is probably a little too far-fetched, and even by definition.
And what do you think that India will be able to manage it pretty barely in the past, or it will take a little more time? So what's your AMC view on that?
Yeah, I think it'll. So one thing is the acknowledgement of the problem which is there. So like I said, even before the war started in the end of Feb, you had external account issues, and we've seen how the currency depreciated relatively versus other emerging markets. And now the West Asia conflict has sort of increased the impact, or rather accentuated it. So there are certain short-term nuances, and there are sort of some medium-term nuances also. Right? So in the short term, like I said, the market initially, after the conflict, tried to decide whether this is a price problem, whether the price effect is what is going to dominate, and then market probably thought, no, it's probably going to be a supply problem also. It's going to be an availability problem. So growth is going to get impacted. Now again, we see sort of a price problem, that being given more weightage. So I think markets are also figuring out, but net price impact sort of at this point in time seems to stand out. And from that perspective, we'll have a little bit of back and forth, and we see volatility. It's ultimately at the end of the day geopolitics, right? So where the war is headed, where commodities are headed, does it go to maybe not? It doesn't go back to where commodity prices were before the war. Probably going to stay elevated, but come off from where it is today. Things like that, and that will depend on all these factors that I mentioned, and that will again impact what policies we take. So the RBI on monetary policy and fiscal policy. And the other thing is from the medium term, like I said earlier, there is some form of external account pressure that is going to remain for a few months into FY 2027. So that will be a challenge, but I think it's okay. I think from what we understand, the policy measures are headed in the right direction. We keep hearing on market chatter about probably measures to shore up some dollars like we did in 2013, or probably some of the measures that monetary policy comes up with. We also keep hearing about fiscal policy probably taking actions related to taxation and things like that. So we'll have to see how this sort of plays out. In the meantime, I think fuel prices, etc., have gone up after initially not raising it. I think that's also a very important channel to adjust our trade deficit and so on, so adjust our exports and imports, so that the price effect plays out in terms of reducing the demand. So I think that's also a natural market mechanism that plays out. I think with the right policy, again in the right direction that we see as of now, and market adjustments, and we should see through.
Okay, sure. Since you mentioned about the currency depreciation, we all know the currency has been falling consistently. So for a common investor, should we see, or should they see this as a crisis, or is it a genuine market adjustment for the price?
So currency, by definition, we are an emerging market. We are not just a net oil importer, we are a net primary commodity importer, right? So within emerging markets, you have to differentiate. So we keep comparing ourselves to, let's say, Indonesia, Malaysia, the Southeast Asian countries, or some other Latin American countries, the emerging markets there, But I think within the emerging market basket, we have to sort of differentiate which countries are net commodity importers, which are net exporters, and what is our structural strengths and weaknesses, to put it that way. And therefore, for us, what we see is we've had a current account deficit, typically around 1 to 2%, and of late it's been much lower. In that sense, our currency generally, on average, let's say depreciates around 3% per year. This is on average. I'm not saying it happens every year exactly with the same measure. And I think the RBI governor has also mentioned something to the same effect on TV. So that is understandable for the kind of economy that we are. And what we are witnessing for some time before the conflict and more accelerated during the conflict is the depreciation over and above this.
Correct.
Right? This typical 3% or whatever. So that's obviously a challenge. And there are multiple reasons for this. So one is that now, see, global rates are much higher. So global neutral rates have moved much higher. So if you look at US, you look at Japan or Euro area, like we just mentioned, fiscal deficit is much higher than now what it was pre-pandemic, right? So that's one of the big reasons. AI related, driver for growth. AI has been a big driver for growth. So growth has consistently sort of been above trend in the US. And for these reasons, their bond yields are now much higher than what it was pre-pandemic. I mean, treasury bond yields, if you look at 10-year bond yields, for instance, it was under 2% pre-pandemic. Now, I think latest I remember for 10 years is around 4.5, 460. So that's quite a big move consistently. And nobody sees the drivers like fiscal, etc., coming off in the near term. Fiscal deficit. So net government spending is going to stay elevated. And that's that is one of the main drivers of yields, right? And similarly, be it Japan or Euro area, there are other reasons apart from fiscal also there. And so for this reason, our interest rates have to sort of adjust a bit because this creates a sort of a situation what is typically called impossible trinity in monetary policy. I'm sorry, I'm getting a little technical here, but I hope I can simplify it for you. So in monetary policy, they say, you have three things which you can't do everything at the same time. So one is to have a completely open capital account. Second is to have a fixed exchange rate. And third is to have a completely domestic growth inflation focused monetary policy. Let's say be it rates or anything. These three cannot coexist together. It's an impossible trinity, right? So that I think that acknowledgement is there. So while we think about our rates in terms of our rate trajectory and where our rates are headed in terms of a typical growth inflation metrics, what we also need to understand is, like I just mentioned, global rates have moved up. There are various capital allocation themes which attracts flows across the world. Be it AI, be it defense spending in the euro area. Japanese assets have cheapened quite a bit. The Japanese stock markets have had a fantastic time in the last year. So these themes, particularly AI, which is a big game right now, and that has attracted a lot of capital, and global rates, the risk-free rates of the world are much higher. I think that's putting a lot of pressure on INR. I think so, therefore, we'll need a bit of both. Again, I'm just coming back to short-term and medium-term. So short-term, we might need measures to shore up dollars, like what we just mentioned, probably something like what we did in 2013 or similar measures. But the cost angle, etc., is different given rates are high now. So we'll have to see what the RBI does and also what government fiscal policy does. And we also need measures to improve our competency, our growth drivers, things like that in the medium term.
You just mentioned that reducing especially for crude oil, increasing the price may help to reduce the demand.
Yeah.
So recently, the Honorable Prime Minister of India, Narendra Modi ji, has advised to all of us to reduce the fuel consumption and also encourage the work from home and also avoid the foreign travel wherever it's possible.
Correct.
So how do you interpret this move in an economic perspective?
Okay, so I think it's in the right direction in terms of where the problem lies. So typically, again, I'm going back to the 2013 example. We always had a current account deficit problem. Now, current account deficit is nothing but the trade deficit and other
Export
components. Primarily export import, and we also have remittances, primary investment income and things like that. But let's say the core of it is net for us net imports, right? So that was typically much higher. And we used to talk about a 2% of GDP CAD being sustainable for a country like India. I think the latest number for FY26 year that ended for March 2026 should be closer to less than 1%, right? 0.7, 0.8% maybe. But the challenge is funding that account now. So the problem that we have is on the capital account side. So the Honorable Prime Minister was probably trying to, introduce measures that probably helps sort of sustain that current account deficit, take it a little lower. Particularly in the context of the war, right? Because we are a net oil and commodity importer. So he's probably trying to, he's addressing that particular angle. But what we also need to understand is that, we should not, that should not create an issue for imports that are meant for re-export. So we also import stuff for consumption, That is where the announcement probably comes from to adjust that. But there are also imports where we add value and then re-export it. Obviously, that wouldn't get impacted likely. The other thing is also, like I mentioned, along with measures to adjust the current account, this time the pressure is more on the capital account, right? So that's where fiscal and monetary policy, the government policy and RBI policy comes in. So hopefully we see measures there as well. And like we discussed just now, the fuel price hikes. So one is the announcement effect where people react to the announcement. The other thing is also the natural market mechanism, which can be quite effective, right? So you and me might curtail our consumption of petrol and diesel maybe if prices go high, right?
Correct.
So that is a natural adjustment, especially if there is an availability issue or if there is much higher prices. So that way, it's how the market works, and that works through prices, and again, prices through currency, right? So that adjustment has to be there. So the price in INR are to some extent a form of shock absorber, right? So it helps reduce demand at a point when prices have gone up. So you naturally adjust your current account, and then along with measures like I just mentioned that the RBI and government takes on the capital account side, we should be able to address the issue on both sides.
We are hearing that FIs are selling Indian market pretty aggressively.
Yeah.
So how do you feel that the effect is impacting Indian economy rather than just a slowdown in the stock market?
Yeah, I think that's a very pertinent question actually, just like our discussion on the INR. So I think we're seeing FII flows, outflows, both from equity and debt. Obviously, equity has been more than what we've seen from debt. That has impacted the INR rates, therefore. And that is the capital account pressure that that we are facing, apart from some pressure on FDIs also. But I think what FII flows create is one is the volatility that you said in markets. But fundamentally, what it does, it tightens our financial conditions, right? So it creates some sort of funding stress for us, especially when there is so much of outflows. That, like what we see today, for instance, in the CD market, the certificates of deposit markets, rates are quite elevated with respect to where the overnight rate or the repo rate is, the RBI policy rate, that is. So that funding stress has sort of made our markets unhinged from where the policy rates are. Because there's a lot of funding stress, like I said there. What it also does is it impacts the transmission of monetary policy changes, right? So what we've seen in the last 1 year, so when we had the rate cut cycle by RBI in the last 1 year, the RBI cut rates quite aggressively over the course of the year, that is, and improved liquidity through various measures like CRR cuts and so on. But because of this funding stress, the transmission that happens to the economy will not be complete, or will not be probably lesser than during other times, because this funding stress and the external account pressure is there. So I think what it does it from a macro perspective is that therefore tighter financial conditions, some sort of funding stress, incomplete transmission to rates and so on, and therefore the outflows I see fundamentally created both by global and local factors, just like in FDIs and FIIs. Either you can have higher rates elsewhere, like we just discussed, which is creating some outflows in a more medium-term fashion, and then there are short-term triggers to it. And there could be certain domestic factors for any country, just not saying just for India, but for any country, there will be various factors like, valuation, taxation, or probably some other macro reason particularly, due to which the money flows out. So I think this is what FII outflows have created for India in the current context.
So despite all these problems, so do you all think that in long term India is the greatest growth stories among the world?
Okay.
So though there are problems which we are discussing right now, so what makes India as a strong growth story in for the next decade or a couple of decades?
Okay, so you're asking about the structural
growth story of
positive,
India.
yeah.
Though there are problems what we have discussed now,
Yeah.
still what makes India as a growth story for the next decade, at least a decade?
Got it. I think, structurally we have positives. So maybe we are cyclically in a phase where we are facing problems, but that's not to undermine our positives as well. So we have, what we often talk about, the demographic dividend. So we have a good amount of, good share of working age population, unlike, let's say, for instance, China or some of the advanced economies, where the share of working age population is coming off. We don't have that. In fact, we have, we have a good share of them, which is positive. So the challenge there would be skilling them. So we have a demographic dividend. So how do you reap that dividend is a question, through skilling, creating jobs and employment and wage cycle opportunities. And therefore, from that angle, I think we also have certain other positives going on. One is the infra development that we had. I think we had a good, decent infra development, but that is a continuous process that needs to be ongoing. And the other thing is also digitalization. I think digitalization has really helped our economy quite a bit in the last few years particularly. So 3-4 of these things are positives, but at the same time we've become. I mean, we've probably not become, but we were more of a services economy, and we've sort of not less of we are less of manufacturing, right? So unlike let's say China, and so I mean we've again had the benefit of that. We've moved from IT services to professional management services. We've had global capability centers (GCCs), and our services trade has really picked up, and that services trade balance is to some extent. I mean, the reason why CAD is below 1% of GDP today is because our services trade balances or trade surplus has improved, and that has offset our goods trade deficit to a considerable extent. So those are positives, definitely. But there are things to work on, just like for any economy. So on the manufacturing side, we need to be, I think we need to have a strategic industrial policy and regulation, and etc. surrounding it, where we identify product sectors, markets, and drive policies there, and therefore create, like I said, to what do you say, to create opportunities for the demographic dividend that we talked about. I think those will be important in the medium term to long term.
Since you spoke about the demographic dividend of India,
Yeah.
since now we all know the AI is the buzzing trend in the world.
Yeah.
So, do you think that our youngsters are much more capable in adapting AI or adjusting to the trends compared to the rest of the world, especially the other emerging market with the Chinese or the other part of the world?
So that's a little difficult to say. I've not seen any material that suggests either whether we are better positioned or not. I think the question now is we are trying to understand as we speak, right? So AI is a very new phenomenon. So you and me are trying to understand how it impacts. So what we know, it increases productivity. But I think obviously there's a lot of fear about how it displaces jobs. Again, we are yet to ascertain the complete effect of it, and even from a wealth distribution perspective, right? So we've heard about AI dividends being talked about in South Korea, for instance, recently. So things like that, I think policy is also evolving around it. But what we probably also understand is, again, we have to sort of separate the short term and the medium term. We could see some displacement in certain sectors, but there will also be opportunities which sort of sectors which are supporting AI. There'll be augmentation there, and I am a firm believer that probably in the longer term, obviously there'll be a churn and there'll be things that happen in the short to medium term, but probably just like any other innovation and discovery that has happened, be it railroads, electricity, computers, internet, and so on. In the long term, I think the pie will grow, and everyone gets richer, and you will have more avenues to spend. But the nature of jobs will change, so we might need reskilling. So how our again demography adjusts to that reskilling, how our IT sector adjusts to that comes up. Maybe there are price pressures in the shorter term. I mean, this is my understanding. But I'm really not sure how we are better placed or worse in terms of positioning with another emerging market. I think we're all figuring out.
Yeah, let's hope that we'll adjust better than others.
Yeah.
So there is a lot of buzz about investing in emerging markets, especially after the recent rallies. So we all know Taiwan has raised, South Korea has increased, China has increased almost 40% in the last 1 year.
Yeah.
So we all know stock market is a reflection of the economy.
Yeah.
So how does India placed among the emerging markets? So how do you feel?
Okay, so obviously the theme that you just mentioned is, I think, mainly because of AI, right? So there's been a lot of flows that the Macs have attracted in the US, and then supporting sectors like infra, power and cooling and so on within the US itself, and now more towards chip manufacturers in South Korea and Taiwan like TSMC, SK Hynix and Samsung. And I think that has been a very fundamental, very big theme that has attracted capital flows in the world in the last few years. So the data says we've not been a very big beneficiary like, let's say, Korea and Taiwan. So I think we need to plug into that theme to some extent. I think we are, policy-wise, probably we are in the right direction with respect to data centers being set up, incentives for that. So that's a good thing. And from a macro perspective, I think definitely we've improved in the last few years, right? So like you said, if you look at it macro-wise, as a reflection, so our growth, it really needs some improvement. But if you look at our macro indicators like current account deficit, fiscal deficits, inflation, etc., right? And that is, so our internals are looking much better. Our macro situation is much better, therefore, and that's not by chance. That is a conscious policy decision also, right? So RBI has been a big part of that. So if you look at central bank credibility, we have a very good flexible inflation targeting policy in place, and that has really helped us. And how RBI manages our domestic priorities of growth inflation, I think that's been a big thing in the last 10 years. But the other thing that is also important is like I just mentioned is that certain themes that you need to identify, have a strategy around that, have a policy around environment around that. I think that's happening. That should happen. So good macros are definitely a necessary condition, but probably not a sufficient condition. With the right policy, I think we should be positively placed for the next few years.
Why I asked this question particularly because of there is not much return from the India,
Okay.
at least for the last 12 to 18 months.
Yeah.
So especially the emerging market has given much better return.
Yeah.
So there are a lot of talk or thought process among the investors to divert money from India to the emerging markets.
Okay.
So that is a background of this question. Yeah.
Got it.
So you think that that's a temporary problem, and over a period of time, India will be able to perform much better because of the our macros are so strong.
Yeah, I think the cyclical problems that we have on the external account, is definitely it's not like a crisis, but definitely we have pressures there. And with the right policy environment, we should be able to turn it around and then get plugged into growth themes. And once we have the right growth drivers in place, and with the structural advantages that we just discussed, your earlier question, I think we are definitely positively placed.
Okay, thank you for answering, clarifying that. Okay. So we can hope that will investor confidence will come back on India, and they will start investing aggressively using this downtime in the market.
Absolutely,
Since you are coming from the fixed income background, so I would like to touch upon that area as well.
Sure.
So especially in the past, we Indians are more focusing on the equity in their asset allocation.
Yeah.
So when we talk about investing in either in mutual fund or investing in the market,
Okay.
the obvious thought process comes to investing in equity.
Okay.
So, but the other side of it, the debt products are becoming more attractive. So, what do you think that the Indian debt market is entering into a golden era, at least for a short to medium period?
Okay, I mean, I wouldn't really call it a golden phase per se. See, first of all, I think, like you rightly said, investors also need to realize that fixed income is a fundamental part of asset allocation, right? You need a well-balanced portfolio. You need fixed income along with equity. So equity is probably for long-term wealth creation and so on, but we need things like stability, predictability, liquidity, and that is what fixed income offers. The current scenario, what we feel is it definitely offers you those good entry points. We've seen some funding stress, etc., and in the shorter segments, etc. So therefore, rates and the yields are quite attractive, for people to enter. That is cyclically at this point in time, and therefore, from that perspective, and even from a medium-term perspective, I think fixed income is definitely that something that any investor should look at as part of their portfolio. I think it is also important not to chase past returns. I mean, just stating the obvious here. And not to be over-invested in the same asset class, right? You need diversification. So you diversify long-term wealth creation, rather you have long-term wealth creation along with stability and predictability of fixed income. I think that's what I would put it at.
Just for clarification,
Yeah.
Especially in Kerala, most people understand only FD as fixed income.
Okay.
So apart from FD, I don't think the large part of the population may not be aware about fixed income, especially in the bond markets and markets like this.
Yeah.
So can you clarify for a layman man, what do you mean by investing in a fixed income? So what happens there? So why that can generate a predictable income for investors, and why that stability is coming from investing in allocating a smaller portion of your asset allocation into debt?
Okay. So, like I said, see, fixed income investments fundamentally invest in government, like GSECs, state government bonds, or corporate bonds by rating. And there are different funds that cater to different people's risk appetite, investment horizons, and so on. So, let me tell you what mutual funds offer in the fixed income space. That would be probably more easier to understand.
Correct.
So, one, it offers liquidity. And then it offers different maturity options. So you can invest in instruments depending on the fund that you invest in. Let's say in a one-day related fund to parking your short-term cash to something like a 30-year bond, right? So you have a spectrum of opportunities there, and it offers you stability. And the important thing is also that it offers various options to reap some benefits from interest rate cycles, so interest rate changes. I think these are the 3-4 things that I would therefore say. And even in fixed income, you can typically what we call a core satellite approach is something that you can follow. So you can put, depending on your risk appetite investment horizon again, to certain core investments, and then have some satellite investments there as well. But along with equity, definitely, I think it's again chasing returns and having more investments in the same asset class is something that people should try to avoid, and that probably comes with fixed income and not just FDs, but through professionally managed mutual funds.
And I also feel that compared to the putting money in your bank, so even though that comes with a lot of safety,
Yeah.
you need to pay a lot of pre-closure charges, whereas you are not paying any pre-closure charges in a debt fund.
Okay.
And also your tax difference, that tax deferral is also happening because in bank FD that TDS is always been deducted at source.
Okay.
So that even if you are placing money for 3-4 years, every year TDS will be deducted.
Correct.
But in mutual funds, you are deferring the tax.
Yeah,
So that in the end you are paying. Though you are paying the tax at the similar rate,
Yeah.
but because the interval differs, you are also gaining little bit on those sides.
Yeah.
So most investors are not able to capitalize on those things because of they are not aware of these
Got
kind
it.
of product.
I get your point. Yeah.
Okay, so it's nice catching up with you to have a conversation. So from your wisdom, what advice we can give to our audience as an investors, as a wealth creation point of view,
Okay.
or what behavioral aspect they should be having to create generational wealth for them and their family, especially in uncertain times like this.
Okay. I think I'll first take a step back and say, from a fundamental perspective, asset allocation is very important. And I couldn't stress that more. I think there are a lot of studies and data also which probably indicate that it is equally, if not more important than, identifying the right funds also, right? So to have a stable, well-balanced portfolio, you really need to, emphasize and, spend a lot of time on asset allocation, particularly just the way you do it on identifying funds. And for that, fixed income also really comes in from that angle, that like what we just discussed. And some of the basic stuff like just mentioned, not chasing past returns, over investing in the same asset class, some pitfalls to avoid, being patient, being disciplined about your investments, separating the signal from the noise in a situation like this. I think that's really, really important. And I think that is what will create wealth over time.
I think that's a great point because a lot of us and a lot of calls what we are getting from our investors is also searching for a good fund. Which one is the right one to invest it right now?
Yeah.
But as you correctly put it, having a right asset allocation is far superior than selecting a one or two right funds.
Absolutely, it's very important.
Yeah, so I think that's the biggest takeaway of the conversation. And I thank you for taking a time out from your busy schedule and having a conversation with all our audience.
No, thank you so much. It's my pleasure to be here. And thank you so much again. Yeah.